Welcome, everybody, to Basic Trading Episode 3, where we're going to talk about the trading system, what it is, how it's useful, why you need one. And we're going to then get into the tactical details after this episode, where we're going to dive into exactly how my trading system looks and all the things that you can use from it that might be beneficial to you. Before we begin, I just want to remind you that this presentation is not financial advice, and I'm not a financial advisor. So hopefully that you find this useful. And let's dive right in. So you've seen this quote from me before. I posted this in a prior video a couple years ago, but it's always a good one to just read. I think it's one that I think about a lot. And it's from James Clear's Atomic Habits, which is a fantastic book. If you haven't read it, I highly recommend it. It's probably one of the top 5 books I recommend for traders. So you do not rise to the level of your goals. You fall to the level of your systems. Such a powerful statement. We all want to, make money in the markets, right? But ultimately, our ability to make money in the markets, our ability to be profitable traders, is going to rely heavily on the systems that we use to trade. And so that's what we're going to talk about today. And so we're going to talk about what a trading system is, and that's going to be selecting markets, the types of trades you're going to take, why timeframes matter to the types of trades you're going to take, the actual system itself. Helps you manage position sizing, tells you when to enter, tells you when to take profit, and most importantly, tells you when the trade has failed. So we're going to dive into each of these little sections. This is going to be a relatively short video, but hopefully you'll find it useful, and it will set up the structure for all of the aspects of the trading flywheel that we talked about in the last episode, so that you can trade those more effectively as you build your flywheel out over the next weeks, months, years, decades. So selecting markets. Before you can trade anything, you need to pick the financial instrument to trade. So this could be, there's lots of different markets. We've never seen as many markets, and we've got things like poly market now too, where you can basically trade anything. But we have so many different markets, and the most commonly traded markets, are stocks, forex, futures, options, and cryptocurrency. Those are all very common. Many of the markets within those are highly liquid, and people find them useful to trade on a regular basis. And every market has its own nuance. Some markets are going to be more volatile to certain things. Each one I like to think of has a personality, right? Every market has its own personality. The S&P 500 is going to have its own personality. The NASDAQ 100 is going to have a slightly different personality that's maybe more heavily influenced by the Mag 7 and big tech. Of course, the Russell is going to be more influenced by small caps and all the macro that surrounds that, et cetera, et cetera. And then, of course, you can get into individual tickers, Apples and the Microsofts and the Googles and the NVIDIAs and Teslas of the world. And finding the right market to trade, it can come from a mentor, it can come from your own research, from trial and error. There's really no single right choice for every trader. So some of this is just going to be discovery. You're going to have to figure out what works for you. But I'd say the most important thing to do is to choose something that's very liquid. And that means you should be able to get in and out of the market very quickly. Like, you should be able to execute a trade. And if the trade's not working, you should be able to get out. If the trade works well, you should be able to get out with a profit. And it should not be hard to execute that trade in either of those situations. So that means having a relatively tight bid-ask spread where sellers and buyers are mostly in agreement about what price should be or where price should roughly be. And you're not seeing massive bid-ask spreads where you might enter at one price and then, there's a mistake, this trade's failed, I need to get out. And all of a sudden, just because of the wide spread that you have, you end up losing a ton of capital just for the fact of lack of liquidity in the market. So it's really important to pick that. For the most part, I trade S&P 500. I'm mostly a SPX and SPY trader. But trading, the various instruments of the S&P 500 definitely meet the criteria. ES futures, very liquid. SPY shares, I think, are the most liquid, or one of the most liquid things in the world. SPY options chain, SPX options chains are all very liquid as well. Now, I'm not suggesting you have to trade any of those, but those are pretty common, highly liquid, and can be good for some of you. So once you've selected a market, right, you figured out what you're going to trade. You're going to trade Apple. You're going to trade Microsoft. You're going to trade NVIDIA, right? And you should be pretty selective about it and pretty focused about it. I think there's people that can trade lots of different markets. I think it's easier to trade more markets when you're when you're not trading short term and you're kind of thinking longer term, it's a lot easier to trade 10, 15, 20, right? That might even be too many. But when you're trading, shorter term, it's much harder to manage a large number of these. But your system will help you with that, and depending on how you construct your system, it might make it easier or harder to execute some of those trades. So typically traders are going to fall within a few categories. We've talked a little bit about this in past videos as well. And it's going to really mostly relate to how long you want to hold your position. So really 4 types of traders. So you've got scalpers that are trading seconds to minutes. I think a lot of people would say probably under 10 minutes, under 5 minutes is kind of like a typical scalper. I like to think under 30. That might be a weird way to think of it, but for me, anything under 30 minutes for me is a scalp. Day traders are thinking, minutes to hours. So 30 minutes, 40 minutes, hour, all the way up to the entire day. It could be a whole day of beautiful trend day. You scale out along the way. And swing traders are looking to trade, maybe overnight to several weeks. It could be a few weeks out, run up into earnings, could be a squeeze play, anything like that. And then you've got position traders, and these folks are going to be holding, for weeks to years. This could be, you buy some Apple shares on a nice dip like the one that we had in February through April. You had a beautiful dip. You could have bought some NVIDIA shares or Apple shares. Maybe you're holding those and scaling out along the way. It's been a couple months. We reach targets and you execute your trades and take some profit. When you're starting out, you kind of need to figure out which one makes the most sense to you. And it can vary based on your personality. It's going to be hard to do all of them, right? It's very hard to switch context from, let's say, scalping for a few seconds to maybe swing trading and holding for several days to position trading where you're holding for weeks or months, right? Now, many people can do all of them, and that's certainly very possible. And you can build a flywheel where these different types of trades, will be executed in different aspects of your flywheel, and you can build out a bigger system to sort of help you with that over time. But when you're starting out and you're trying to learn how to do things, it's best to kind of figure out what works best for you and kind of lock into that. And then you can slowly start to build what makes sense for your long-term flywheel. So the first thing your trading system needs to do, we're going to talk now, let's get into some more details of the trading system. First thing your trading system needs to do is it needs to tell you how large your position is going to be. And this is a very, very critical point. There is no random position sizing. This is so important. Without consistent position sizing, trades can influence your P&L in very crazy ways, very random ways. And most importantly, it's likely going to influence it in a very bad way to the downside. This is, in fact, how a lot of people blow up accounts. You'd be surprised how many people do this. It's a pretty common situation. You may make $100 in one trade, you get super cocky, you size up big, maybe even full port, right? Next thing you know, you blow up the account, right? And it has nothing to do with your skills. It has nothing to do with the ability to, execute a trade. The only thing it did is that you oversized relative to the size of your account. And that's incredibly dangerous. So if there is one thing that I can convey to you, it's that your position sizing needs to be consistent. You need to have a consistent position sizing. When you're starting out, it's best to start small, get consistent first, and learn to get good with very small size and then slowly scale up as you're able to. Picking position sizing is very personal and it varies based on appetite for risk. But when you're starting out, start as small as you possibly can and give yourself a chance. Giving yourself a chance to exit with a loss and still be able to trade again is so key, right? You're not trying to win on one trade. I think this is the unfortunate truth of social media, and you see these big wins. Somebody takes one trade, full port, they make so much money, everything's great, right? Life's good for these people. Well, for most people, that's not the case. Usually it's a blown account that happens. So it's very important to think of it in terms of your ability to execute multiple trades over a period of time where any one trade is not going to cause the ability to not be able to execute against additional trades post-loss. It's very important to think about it that way. So your wins and losses are going to be a semi-random distribution, right? You're going to win some, you're going to lose some. Nobody wins 100%. That's nobody that I know of does. Maybe you can get a high win rate, right? Maybe you are very good at execution, incredibly patient, you have a really high win rate. That's great. But it's going to suck if your one loss takes out 9 of your wins, right? That's not going to, you can have a 90% win rate, which would be insane. And one loss can absolutely smoke your entire portfolio if you're just randomly sizing on that one trade, right? So your wins and losses are going to be a semi-random distribution, meaning there's going to be wins, there's going to be losses. It's somewhat random. For the most part, it'll be under control to a degree because your ability to patiently wait and execute only the setups that you're willing to take. And then most importantly, manage the downside is what will produce the profit, right? If you take, let's say, I think I've shared this example in the past. Let's say you've taken 3 trades. One trade's a massive win, and the other 2 are really small losses. You are a 33% win rate trader that's profitable. Okay? The other person B, takes wins 9 out of 10 trades, right? But the one loss is a massive loss. They're a 90% win trader that's unprofitable. So your ability to manage the downside is equally critical to your ability to execute against the setups that you see, the entry criteria that you see. And so you're at the end of this, the system needs to keep you from taking big losses. Big win is the goal. It's not always going to happen, but obviously we want to take good setups and we'd like to get as big of a win as possible. And that's going to be, taking some profit at predefined exits and leaving runners, and then exiting when appropriate, right? Small wins totally acceptable. Sometimes you'll enter a trade, looks good, maybe it looks like it's not going to really fulfill its destiny, and so you take the small win and move on. Small loss is also acceptable. That's fine. Now, to a point, right? When you start to see you're making too many of the small losses, you can also get into a death by 1,000 paper cuts, right? So you want to make sure that you're still managing your entry criteria correctly. You're taking good setups and you're being patient. What you don't want to do is take random trades and lots of small losses. That's just as bad in some ways, maybe even worse for your psychology than a big loss. And a big loss is unacceptable. That should never happen. You should protect yourself sufficiently on an individual trade basis so that a big loss never happens. And what I mean by a big loss is something that would be catastrophic to your P&L. You want to make sure that those losses are contained. So the next important thing is your trading system tells you when to enter. Your system needs to have conditions in place for when you enter trade. This can be a trade setup. This can be certain criteria. This can be based on technical patterns. It could be based on a whole number of things. If the conditions aren't met, you don't do anything. You don't do any, you're not clicking buttons because it feels good. You're not dopamine seeking. You're not doing any of that stuff. And this is probably the hardest thing for a trader to do. You're constantly being shoved FOMO from everywhere. Like there's so much stuff being thrown at you. And you have, as part of being a trader is your ability to sit and experience all that is happening in front of you. And no matter what, still wait and only execute your trade when the conditions for that trade can be met. Now, conditions vary. There's so many different ways to trade, and I can't teach you all of them. I'm going to teach you in the upcoming episodes how I do it and things that I look for, and maybe those will be beneficial to you, and maybe they won't. That's fine. And you can discover there's plenty of traders out there doing all sorts of things, so you can find what works best for you. But ultimately, the conditions are going to be based on some basic concepts that everyone is kind of looking at. Price action is a pretty common one, supply and demand, support and resistance, candlestick patterns, chart patterns, etc., right? Price action is a very popular way for trading. Technical indicators, moving averages, RSI, MACD, ATR levels, phase oscillator. That's a little self-serving, but you know what I mean. And technical indicators, this is something that I think people may or may not agree. There's a lot of people that are very dogmatic about what should be used for trading. There's no right or wrong way to do this. There's people that will tell you, oh, all you need is a line tool and price and volume. And they're not wrong. You can certainly trade that way. I did for many years. There's some people that say all you need is a moving average, and they're not wrong. I've done that for many years. There's some people that swear by RSI or MACD. There's some people that love my indicators, right? And they'll swear by them, say it's the only way to trade. That's not true. You can find what works for you, right? And so there's people very dogmatic about what trading is. But trading is is individual. Whatever makes sense to you, wherever you can identify the same pattern, repeatable pattern over and over and over again, that setup over and over again. Doesn't matter whether you're looking at supply and demand, whether you're looking at chart candlestick patterns, whether you're looking at some sort of interaction with a moving average, or whatever it might be, right? It doesn't matter whether you're looking at price to earnings ratios, specific macro news, all these things. As long as it makes sense to you, and if you see something that makes sense to enter a trade, and you've seen it before, whether it's through back testing or whatever, that's fine. Don't listen to the dogma. You can find the way to trade that works best for you. And everybody's going to be slightly different. Some people maybe you take my system and you adjust it a little bit. That's perfectly fine. People do that all the time. And I love it. You got to find what works for your brain. That's very important. So there's various different conditions for entering a trade. And we're going to talk about some of the ones that I look for in upcoming episodes. And I've also had, things like the VAMI setup and the Golden Gate strategy and all those things that you can look at. But we're going to talk about more of these setups. People have been asking about mean reversions and all those kind of things. We're going to go into detail around those. But ultimately, your system needs to tell you when you're going to get into a trade. The next thing your system needs to do is, okay, you're in a trade. And you need to know when you're going to take profit. This should be known before you enter the trade. We've talked about plans. Plans have to have, why am I getting in? What's my thesis? Where's my entry? Where's my exit? Where does the trade fail? And those are very important things. But your system needs to tell you this. If you don't have a clear, well-defined, and predefined reason to exit a trade, you are 100% going to fall into the greed trap. You are definitely going to fall into that trap. Oh, it might go more. Oh, I made so much. Maybe if I just hold a little longer, I'll make back all my prior losses. Oh, I lost $1,000 yesterday. I'm up 300. If I just hold a little bit longer, I'll make the $1,000 back. It'll be good. It'll be great. Next thing you know, that $300 turns into negative $300, and you've ruined your trade. You've ruined your day, and you've dug a bigger hole for yourself. So don't do that. Slow and steady. Make sure you take the trade. Make sure you know where you're going to take profit. And the profit taking criteria, just like the entry criteria, is going to be slightly different. It can be something like technical price levels. That's what I use. But it could be a change in outlook for the market. There's so many different ways to do it. But at the end of the day, profitable traders take profit. So if you want to be a profitable trader, you have to build the habit of taking profit. And finally, I think the most important thing is your trading system needs to tell you and needs to define when a trade has failed. And this can be something as simple as a technical level, like you lose demand or supply or support, resistance on a chart. It could be a fixed percentage stop, which I absolutely hate most of the time. I do use them occasionally, but generally I think unless that percent stop's related back to something in the market, it can be completely arbitrary. Or it could be something as complex, like a model saying the thesis no longer works, any of those things. But ultimately, the best failure criteria should be market focused, not you focused. What the hell does that mean, Sadi? Well, what it means, let's say you enter at some random spot. Does the market know you entered? Probably not. It has no idea you exist. So when you enter, if you're entering at an arbitrary non-market focused place, if you just have a random percentage fixed stop from that non-market focused spot that's based on your entry, right, that the market has no idea about, you'll probably get taken out of that stop. How many times has this happened to you where you've entered where you thought was good? You put a random percentage stop, 30%, 25%, whatever. And you get told this all the time. Everybody's like, oh, you got a percentage stop, right? 30%, it's great. It protects the downside, right? Certainly you protected you managed your risk for the trade. But did you give your trade a shot, right? Because it wasn't market focused. I'd rather size down and, match a particular technical level based on a percent or a fixed value, and give myself a chance for, even if it goes against me, or even better, just get closer, get in closer to that level. And then, so that if it goes against me a little bit, I still know I have got some room, and then it can go in my favor. And this has probably happened to so many of you where you've entered random percentage, gets stopped out, and then the market goes where you thought it was going to go without you. So the best failure criteria needs to be market focused, and we're going to talk a lot about that. We'll talk about what that means in a subsequent video. And this is non-negotiable. When the system says exit, you exit. You do not sit there and go, I could probably go higher. I could probably go lower. Don't do that. How many times have you done that? Has it worked? When it does work, you have now created a terrible habit for yourself. So you need to take yourself out of it. The system says get out, get out. If you have a stop set, great. It's going to take care of business for you. You don't have to do anything. You're just moving stops up. But it's better to get out with a small loss, reevaluate, and you can always re-enter at the cost of commission, right? That's the minimum. So if it makes sense, of course, you don't have to, you don't have to get back in. If it doesn't make sense, you don't get back in. Look for the next setup, next trade mentality, right? Next play mentality, just like an athlete. And you just don't want to hold on to something with hope, right? So we've talked about FOMO, we've talked about greed, we've talked about hope, right? Having failure criteria and having something that's protecting the downside is also protecting you against hope destroying your portfolio. So it's very important. And ultimately, I'm going to leave you with some Aristotle wisdom. We are what we repeatedly do. Excellence, then, is not an act, but a habit. If you follow a trading system and you build a trading system where you can trade like an algo, it's more likely that you'll reach those goals that you really want because your system will rise to the level of those goals. Your habits will form in a way where your system will allow you to be great. And that's Basic Trading Episode 3, Trading System. And after this episode, we're going to start getting into some tactical stuff. And I think we'll look at charts and all sorts of fun stuff. And I'll be sharing with you what I do, what my trading system looks like. We're going to dive into each aspect of things. We'll look at trading setups, and it'll be a lot of fun. Hope you enjoyed this one, and I'll see you in the next one.